Welcome, everybody, to the Ellsworth November monthly update. I'm Kelly Kuennen, Cameron Miele, my associate. And first of all, happy Thanksgiving. As we move into the holidays, you won't hear from us again until the new year. But we'd like to share basically what happened throughout November from an economic standpoint and also with the markets and our various portfolios. As usual, we'll have Cameron start off with a little bit of an economic update.
Okay, thank you, Kelly. Good morning, everybody. We really live in a fascinating time.
Yeah, they always are.
They always are. No, I mean, right now, what we're really seeing, what we've seen over the last month is really a tale of two economies. We've got the consumer. We talked about the consumer slowing down a little bit, but the consumer has rolled back with a vengeance. And at the same time, we continue to see some weakness in manufacturing. A couple of statistics I wanted to quote. The Institute for Supply Management said its manufacturing index sank to 48.1% in November from 48.3% in October. The index has been in a steady decline since July 2018. What's the primary culprit? CapEx spending.
Right.
Trade, a potential trade war, tariffs, global uncertainty. Companies just aren't spending. They're sitting on cash, they're holding on to cash, and that means manufacturing has come down significantly. Now, adding additional fuel to the fire, we've got renewed trade threats against China, and now we have new trade threats against France, Brazil, and Argentina. At the end of the day, we've had presidents for years saying we've got to get tougher with China, with their intellectual property. I give the president credit for what he's done. He had to take on China eventually. They've been an unfair trade partner. The rhetoric might be a little extreme, and that's driving market volatility. But at the end of the day, it is scaring the markets a little bit. That is causing a manufacturing pullback.
I think one point on that, the reality, I think those numbers were a bit of a surprise. Mm-hmm. They were lower than expected. There was a sense out there that things were improving on the manufacturing side. So that was a little bit of a surprise, yep. Which probably why the market was down a little bit yesterday. Today it's down because of
the president and President Macron from France are sitting there,
yes,
sparring right now,
firing up the old the trade rhetoric.
Yeah. So that's manufacturing, but then surprisingly, the U.S. consumer is definitely keeping the train on the rails, and the consumer is doing so well, spending so much that it is mitigated a lot of this trade noise, a lot of the manufacturing. I want to give a quote here. This is from Federal Reserve Chairman Richard Clarida. I cannot think of a time when the U.S. consumer has been in better shape. Debt levels relative to income are at their lowest in 40 years. The savings rate is high, and real consumer spending is growing at a rate of almost 3%. So thus far, the strength of the consumer has mitigated all those declines in manufacturing. Interesting that we've also seen in the third quarter, GDP was recently revised up from 1.9% to 2.1%. Carrying that over, the International Monetary Fund is forecasting the U.S. economy will grow at 2.1% in 2020. If that's true, when we hit June of 2020, the U.S. bull market will be in its 11th year. Now this is fascinating. According to Bloomberg, fascinating, I know. According to Bloomberg, this is already the longest period of continuous economic growth in the United States since 1854.
Wow.
That's impressive. So, I mean, what we take away from that is we keep talking about there has to be a recession, market can't go on like this. But what we're seeing is the consumer is strong, unemployment is low, real wages are up, productivity's up. People are making money, they're feeling good about themselves, and they're spending. And that's really driving this economy.
Well, along those lines, the reality is so yeah, manufacturing looked like it was getting off its back, still struggling. But the diversity of our economy is very diverse. It is more service-oriented.
Absolutely.
And nothing's really, all the different sectors are not firing in sync. Mm-hmm. And we haven't seen that happen really since the financial crisis. So you'll have some sectors that go through, basically weakness. Other sectors are stronger. They flip-flop. And you end up with a 2% economy is basically what we've seen.
That keeps you at that Goldilocks economy.
And it really looks like there's not a lot out there to change that in the short or intermediate term. And I hadn't seen those numbers from the world, who's that? The World Economic or
International Monetary
International.
Fund.
I hadn't seen those numbers, and they're stronger than what I thought they would have been.
I am too. I was very surprised. I think if anything, rather than thinking the U.S. is going to be in a recession in 2020, I think the IMF is now starting to forecast or show a U.S. kind of steady. But now what's exciting is that they're really starting to show the rest of the world coming out of this tailspin. So
that's the sense I've been getting is the rest, with reading other international managers' commentaries and so forth, they're seeing that
they're seeing a light at the end of the tunnel.
We're at the bottom of the valley for international at this point in time.
So this is a summary from the IMF from October 2019. This is their global growth projections. So for the global economy, growth was 3.6% in 2018, down to 3% in 2019. Now they're projecting 3.4% growth in 2020. For the advanced economies, up 2.3% in 2018, down to 1.7% growth in 2019, flat in 2020 at 1.7% growth. Emerging and developing economies, 4.5% growth in 2018, declined down to 3.9% growth in 2019, now up to 4.6% growth in 2020. So, what we're seeing is a lot of these countries that were in the emerging markets were at flat to negative growth. And now we're starting to see countries like Italy, like the United Kingdom, like Germany, having positive growth rates, Japan. China's continuing to accelerate. The Chinese manufacturing index this month was very strong for the first time in a while. So I really think that, the experts, the people that study this for a living, they're really seeing strength now in the overall economy.
Yeah, and it's not rip-roaring strength.
Mm-hmm.
Will we ever break out of this 2% mode in this whole economic cycle? Who knows? It may take till getting through the next recession and the new cycle creates 3 to 4% growth. But the reality
growth is growth.
Yeah,
that's good.
That's the reality is we're not shrinking. That's key. I think we're going to continue to kind of plod along. And, let's translate that to the stock market.
Mm-hmm.
So November was a great month. Let's call it like it is. After the weakness was August and September, and since then we've been kind of cruising, which is excellent. Last December we saw the big pullback, but the reality there is we're definitely in a different place than we were last December. Going into last December, you had the Federal Reserve raising interest rates. You had a lot of quantitative tightening going on. That's kind of been reversed. So we're in a better spot going into this December than last year. I don't see a repeat of last year, bar the volatility of tweets and so forth. That I really think that is short-term volatility. And after coming off a big month, there's a lot of excuses. Hey, let's lock in some gains. But so we give up a couple percent of the 4% we gained last month. But last month, yes.
But then real quick. But then look at between Black Friday and Cyber Monday. There was almost $25 billion of sales in the retail sector.
Which, once again, reflects to what's going on with the consumer.
Yeah. I think this fourth quarter is going to, in terms of spending by the consumer, I think it's going to be strong.
I don't disagree at all. It's, who the and then it's going to be who the benefactors of that are going to be. That's the wild card. You don't know that until come January, where everybody spent their money, but they're going to spend it. And, that's, but it's still going to the economy, bottom line.
Absolutely.
Back to the markets, S&P 500, year to date, this was through the end of the month, up 27.6%. November gave us 3.4% gains in the S&P 500. That information is coming, all the performance information on the markets are coming from Morningstar and FactSet. The Dow up 23% for the year. Last month, 3.72, so the Dow was a little bit stronger than the S&P last month. The international markets, the developed world, measured by the EAFE, last month up 1.27, year to date 18.8%. So international's quietly been, coming on, and it's really been the last couple of months where international's come on stronger. Emerging markets still only up 10.6% for the year. Last month 1.96. We've always had a little bit of a commodity exposure. Commodities up 7.92%. This summer we were up over 9%. So commodities have given back a little bit. We've also seen a little weaker dollar, which I think accounts for some of the commodity weakness. Obviously, energy prices have continued to be at some pretty low rates. in a growth economy, I think that's a good sign that things are, fairly strong in the energy market, or at least from a pricing standpoint, that's good for the consumer.
Yeah.
For the energy firms,
Bottom
not so
line
good.
is, we're a net exporter
Exactly.
of energy for the first time in decades.
Right, and there's a lot of it.
There's a lot of it. Yeah.
How that translates to our portfolios, our growth with income portfolio, which is really the balanced portfolio, for the month we were up anywhere between 1.6 and 2%, so a decent month for growth with income. Year to date, that portfolio is up 16.01%. Price potential portfolio, this is our growth portfolio for the month, up 3.71%, pretty good month there. Year to date, 26.55%. So, really between the Dow and the S&P, almost at the S&P levels, and this is after fees. Dividend yield up 1.71%. That's our conservative dividend-oriented portfolio. Year to date, that's up 21.83%. And small caps, which they've been pretty volatile this year. Last month, up 5.25%, taking us to 18.69% for the year. So, like I said, small caps are across the board. They've been up and down. Last month was a great month for small caps. Regained a lot of ground there. From a gainers and losers standpoint, not a lot of losers last month. Growth with income portfolio. Disney had a big month, up 16.67%. CVS 13.38. CVS was struggling. They've kind of turned the corner. We're seeing a little bit more life coming into the healthcare space. NVIDIA, chip stock, once again, chips struggled a little bit in the fall. That was up 7.9%. Apple had a nice month, up 7.75%. Apple's, valuation-wise is, kind of creeped over that 20 PE ratio, which we haven't seen in a long time. I can remember talking about Apple being at 13 times earnings. Now we're at 20. So Apple, getting a little extended, but they're still not crazy overvalued. From a downside in the growth with income portfolio, the only two places we were really challenged of any significance, gold, we were down 3.21%, which with a little weaker dollar, that makes sense. And the fact that, some of, perceived risks have come off the table.
Well, the stock market's roaring. People aren't thinking about hedging with gold.
Exactly. So, we're still up nice in gold for the year. We're probably up 8 to 10% in gold, which it worked when we needed it to. Cisco, down 4.63%. So a little bit of surprise to the downside from Cisco. Price potential, big gainer in there. Target, 17.63%. Pretty much everything in price potential was up. Target was just up the biggest. We had no negative. None of our stocks in that portfolio in November were negative for the month, so that was kind of a rarity. Usually something's something's down, but not last month. Dividend yield, British American Tobacco up 13.3. Boeing actually up 8.35. So Boeing kind of flat for the year. They've had their issues long term. I mean, they're still the largest airline maker, and beyond the 737 issues, they continue to land a lot of defense contracts, so Boeing's not going anywhere, and it's just a matter of riding through the issues on the 737. Downside in the dividend yield, Con Ed was down 4.97%, AT&T down 2.86. I mean, those were biggest losers in there. So once again, it was a pretty good month. SMID, we had here's some crazy numbers. America's Car Mart up 20% for the month. Verisight up 25% for the month. Novacure up 28% for the month. And on the downside, no real big negatives besides your usual handful of companies down 5-6%. That's why that portfolio is up 5% for the month. So in general, great month. Obviously, we're giving a little bit back these last couple of days. I think a lot of that's
buying
headline
opportunities.
Yeah, it's headline risk. A little bit of portfolio repositioning. I think I've looked at doing some tax loss selling. It's kind of difficult because we're not sitting on a lot of losses this year, which is a good thing. So I don't see a lot of tax loss selling between now and the end of the year. If they've done it already. So I expect things not, between now and the end of the year, will we get some more gains? I would not, I kind of think we will. Will we have some volatility early on? Probably. As we get into the holidays, I think the headline stuff will probably go to the side a little bit. But, in all, it's going to be a decent year. Going into next year, looking at the economy, not much is changing. I think we continue to plod along. first quarter earnings, we'll start seeing those in February, and that really tells the tale of how strong we're companies. We still look at positive earnings growth, and that's kind of the key.
Absolutely.
Other than that, that's kind of where we're at. Once again, happy Thanksgiving to everybody.
Happy Thanksgiving, happy holidays.
Happy holidays.
Hanukkah, Merry Christmas.
And we will talk to you first week in January.
Thanks, everyone.
Have a great year end. Thank you.